Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 304 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, I want to talk to you about a particular type of investment product. Now, these are relatively new in the way that they're being used and the way that they're being created, but I think it's worth talking about, especially in a market environment when a lot of people are looking for safe ways to grow their money. They're afraid of a crash, they're afraid of a bubble popping, and they're trying to find ways to de-risk. And this particular type of product, this particular type of instrument is just a derivation of something that we know and that we've talked about multiple times and that we will rehash in this episode. But I want us to be aware of what's out there. That way we can know whether or not this should be an actual part of our investing process or not. And we can make proper decisions as long as we know what we are invested in. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that single plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who watches or listens to this show on a day-to-day basis. So let's just talk for a moment about the ETF, right? We've talked about what ETFs are before, and we've talked about investing in ETFs, and I've told you that I hold ETFs. I don't see much wrong with ETFs. We've talked recently about tax changes that are proposed about ETFs, and I don't know if those will actually go through or not, but it allowed us to rehash the idea of what an ETF is. And so if you do not know, ETF stands for Exchange Traded Fund. Right? And this is very, very similar to a mutual fund where it's a bunch of people's money that is pooled together in order to buy a bunch of different stocks or a bunch of different bonds or certain different types of portfolio mixes that are chosen by some portfolio manager, right? And the difference between this and a mutual fund is that the ETF, the shares of the ETF are traded throughout the day. So when I buy a share of an ETF, I'm buying from another individual. Or if I'm selling a share of ETF, or if I'm selling a share of an ETF, I'm selling that share to another individual, right? But ultimately what it's doing is it's tracking something. It's tracking some group of stocks, some group of bonds, some group of assets, right? Typically ETFs are indexed, right? Meaning that they track a particular index like the S&P 500 or some other major index that may be in the stock market, the bond market, or whatever, right? But they don't have to be. They can be far more active, and they are becoming more and more complex by the day. People are using ETFs for all types of things, and ETFs currently do have a tax advantage over the mutual fund because I am buying and selling to and from other investors, right? Not to and from the mutual company itself, who's having to, buy or sell actual shares of whatever they're holding in order to get me my money, right? So the inflows and outflows of money from a particular mutual fund are going to have impacts on your taxation, but with an ETF, they don't. Right. And this may be a very, small amount for individuals that, don't have a ton in their ETFs or in their mutual funds. But for those who have a lot, ETFs can provide some tax efficiency. Now, why do I talk about ETFs? Why is ETFs at the center of what I want to talk about today? Because the particular product that I want to talk about that people are pushing into, not everybody, obviously, but it's gained a lot of steam, it's gained a lot of ground, is what they call defined outcome ETFs. Okay, defined outcome. Now, when I think defined outcome of anything, right, I think that before you start, you know what the outcome is going to be. You know what is going to happen. Okay, so is this saying that with this ETF, you know what return you're going to get, or you know what's going to be the end game for this particular ETF? Let's dig into it. Okay, so this is a particular article from ETF Stream, and I want to go through it and talk about this product and give a little commentary as I go. So if ETFs had an arch enemy, then they would probably not be mutual funds, but rather structured products, right? ETFs symbolize simplicity, transparency, liquidity, and low fees. All true, right? In stark contrast, structured products are generally complex, opaque, difficult to trade, and expensive. Right, a classic structured product is a note that allows investors to participate in the stock market with defined downside but limited upside, right? Therefore earning the quote-unquote defined outcome moniker. Okay, the same payoff profile could be constructed via a zero coupon bond and an option, right? I'm not going to jump into all that, but could be done, right? Retail investors in particular like these strategies as they seem to provide attractive risk-reward scenarios with so-called defined outcomes. Now, this type of outcome is typically seen in what we call fixed indexed annuities, right? Annuities that they are pegged to some particular index, right? And what happens is you get some percentage of gains of a particular index, but you have downside protection. So for some of those, annuities, there is no downside. You can't go lower than a certain amount that you have locked in at. Right? With some of them, there's limited downside, right? And these defined outcome ETFs are going to be very, very similar in form to these annuities, but they will differ and they stray definitely from the traditional role that ETFs have played. And we'll talk about whether or not that's a good or bad thing. But moving on. Banks and brokerages like selling these products, these defined outcome products, not necessarily the ETFs, but just defined outcome products to retail investors as the fees are lucrative. Keep that in mind. Fees are lucrative. On the face of it, structured products are not always expensive. Some are even free, but the cost disclosure typically does not include the fees from the trading desks that create and manage these over time. Now, there's been very little discussion in the media about structured products in comparison to stocks, mutual funds, or ETFs, but structured products represent a huge market with approximately $7 trillion invested globally, which at the time of this particular article was slightly more than the global ETF market. I know the global ETF market is over $9 trillion now, so I wonder where these stack up currently. Now, given that there are more than 7,000 ETFs covering almost every imaginable index, sector, or theme, issuers have, not surprisingly, turned to importing ideas from the structured product market to the ETF world, right? People are getting bored, right? And they are getting creative with how they create certain products. Now, what we'll do here is we'll look at these defined outcome ETFs, which represent structured products in an ETF wrapper, and they are rapidly becoming popular with investors. So, first of all, what is a defined outcome ETF, right? This is nothing more than a product that provides exposure to a stock index. So think the S&P 500, the Dow Jones, the NASDAQ, whatever, right? And it offers a reduced downside in exchange for a limited upside. Right? So this is a roughly defined outcome for return expectations, right? You don't know exactly the amount of return you're going to make, but you do know that your downside is limited, but so is your upside, right? But people may like this for limited volatility in their portfolio. So, for example, one of the most popular products in this space offers a cap of 8.5% and a buffer of 15%. So stick with me when it comes to this terminology that we're using, cap and buffer, right? So this means that investors participate in the upward movement of the stock market up to a limit of 8.5%, right? So if the stock market goes up 10% in a year, you only go up 8.5%. If the stock market goes up 5% in a year, you go up 5%, right? Because you didn't hit your cap. All right. Above that, investors get no further returns. However, if the index crashes, then the investor is protected for the first 15% of negative returns. Okay, if stocks crash more than that, then investors start losing money as well. The index levels are set when the product is launched, which explains why the product name often includes the month of issuance, and they are reset on an annual basis, right? So defined outcome ETFs in the U.S. Are relatively new, right? Two companies, First Trust and CBOE Vest and Innovator Capital Management, dominate this market and have collectively launched over 50 ETFs in less than 2 years. Investors have allocated almost $5 billion to these products, and inflows have been highly consistent over time. Now, 50 ETFs in 2 years is a huge number, and this just makes me think that these must be extremely lucrative for these companies, or else why would there be 50 of them? Why do you need 50 of these types of ETFs? but nonetheless. Okay, now, how does the performance stack up? I think this is what everybody really wants to know. How does the performance of these defined outcome ETFs really stack up to your index or whatever? The inflows into these ETFs have accelerated through 2020, and I'm sure also into 2021 as things get higher and higher and more bubbly, right? As the global pandemic and market volatility has shifted investors' focus to capital preservation. Right? The crisis also offers an opportunity for investors to scrutinize if the products performed as advertised in the marketing materials. Now, here we look at the performance of 5 defined outcome ETFs tracking the S&P 500, which cumulatively manages more than $1 billion in assets. Okay, we observe that these lost significantly less than the S&P 500 in March 2020 when the S&P 500 reached its maximum drawdown. However, the ETFs also stopped participating in the recovery rally in August as they reached their cap. So think about this. Think about last year being capped as early as August, right? August is pretty early to be capped. Or just think about this year, right? If it reset at the 1st of January, let's say that were the case. Right? If it reset at the 1st of January, how quickly would you have hit a 10% cap or an 8.5% cap this year? Quite quickly. Now, we haven't accelerated way too far past 10% or whatever, right? But you wouldn't have made any extra gains this year thus far. Now, this is important because it highlights the trade-off between the buffered downside and the upside characteristics, which is a key consideration in all defined outcome ETFs. Overall, the year-to-date performance, again, this was in 2020, was as expected with relatively little differentiation between products, which can be viewed as a positive attribute. The maximum drawdowns reached during the depths of the COVID-19 crisis ranged from 15 to 21% in these structured products, which is significantly less than the 34% decrease in the S&P 500, right? So let me just pause right there. If you are interested in these types of products, that would be the reason why. Right? The reason why would be to look and go, okay, my drawdown was 15% versus somebody else's drawdown of 34% because they own the index. Now, let's just think intuitively about this for a second. Just in order to get back to the particular place that you were in your investments prior to a particular crash, right? We can look at how much you need in the way of returns in order to do that, right? And so if the market fell 34%, which it did last year, right? The amount of returns you need from that bottom, okay, from that bottom of being 34% down, you need to make 51.51% to get just back to the place that you started, right? You had to make over 51% just to get back to the same top that you were at before you went into the crash. But let's say that the market went down. Let's say it went down 21%, right? That was that biggest drawdown on one of these defined outcome ETFs, right? You would have only had to make 26.58% in order to get back to the same point that other investors were at. Right, so this is beneficial, but what's the downside here? What is this this downside if we're looking at a good bit of downside protection and then the upside caps are not super duper low? What's the problem? Well, the problem is when you have a major crash like we had last year, you tend to also have some major bounces, right? Some major bounce backs, and boy, have we ever had some major bounce backs. So if you needed 26.5% to get back to where you were at zero, right? You can't even make that if you have a 10% cap over a 2-year period, right? You can't even make that. You can't make up for all the losses. Now, I know that some of those losses occur within year and then they come back. So you could have made up quite a bit in the way of returns. But let's say a crash was towards the end of the year and you closed a year down a lot, right? And then you rolled over to a new year where you could only make 8.5% or 10% or whatever, right? Then it's going to take you longer to get back to the top than it would take somebody else who may be a part of one of the big bounces in the S&P 500. But nonetheless, it decreases the amount that you would have to make to get back to that particular point, okay? Now, the drawdowns in these ETFs vary as the ETFs have different buffers and dates for resetting the index levels, right? There's an underappreciated feature of these products that investors need to be very aware of, as these dates have significant impacts on returns depending on when the investment is actually made. For example, if an investor would have bought into a newly launched defined outcome ETF in March of 2020, then the cap would have been reached relatively quickly, thereby significantly limiting the investor's exposure to the subsequent rally. The sensitivity on the index resetting date also explains why some fund of funds products are currently being launched that allocate equally to ETFs for each of the different months, which essentially reduces the path dependency. So basically what that's saying there is that if that particular ETF would have been launched at the bottom, right, then you would have quickly hit your cap coming out of that bottom in the market, right? But if it would have been launched, let's say at the beginning of the year, you would have gotten some gains up until March of last year and then hit the crash and then been able to work your way out of the bottom of that crash as well. Okay, so that could have benefited you in a different way. So the date does matter. Now, what's the downside of defined outcomes? The downside of defined outcome ETFs. In addition to the dependency on the index resetting date, which again, this can play a big part, investors should also be aware that defined outcome ETFs are based on price-only indexes. Now, just be very aware of what this means. Okay, typically when we buy the S&P 500, right, we buy the S&P 500 and we get the price return of all of those stocks, meaning how much the prices go up in value over time. But we also get the dividend return and the ability to reinvest dividends over time, which has been quite valuable to investors over a long period of time, right? If you just look at long-term returns of the S&P 500 and you wonder, okay, of these long-term returns, what is the percentage of returns that has to do with dividends? Let's just say the last 50 years. Let's look from 1971 to 2021, September to September. Okay, you do that calculation, the annualized S&P 500 return, just the price, right, would be 7.904%. Okay, not a terrible return, but 7.904%. If you reinvest your dividends, it is 10.977% over that same period. So that's an extra 3% approximately that you are making in return by just making dividends and reinvesting those dividends. The problem with these defined outcome ETFs, you are not entitled to the dividends from the underlying stocks. You're not entitled to the dividends of this particular index that's increasing. Okay, so you look at the dividend yield of the S&P 500, which may be pretty low right now, but every basis point counts, especially in this environment where yields are very low elsewhere. Now, sacrificing this dividend yield can end up being a non-trivial cost to defined income ETFs over time, right? You may not think of this as a cost because you're not paying it to the company who makes the ETF or to some brokerage firm or whatever, but you are giving up, right? It's an opportunity cost, right? You have the opportunity to buy the S&P 500 and get these particular returns, but you do not if you are just using these structured ETF products. Now, furthermore, defined outcome ETFs, like structured products, are expensive. Almost all the products are charging management fees between 0.75 and 0.85% per annum, compared to almost zero costs for plain vanilla ETFs for the S&P 500. Now, downside protection isn't free, of course, but it's worth understanding what the true cost is, both explicit and implicit. Now, we take a closer look at both the explicit costs of management fees as well as the implicit costs of excluding dividends as it relates to the S&P 500. In this case, the annual return would have decreased from 9.7% to 6.79% per annum for the period between 1993 and 2020. So if you take the S&P 500 returns, you account for the loss of dividend income and this price for these management fees, right? And you lose nearly 3%. You lose nearly 3% since 1993. Now, this is probably quite a bit more than many investors realize, right? So these costs, they really, really add up. Okay, this is one of the reasons that I am not a huge fan of these defined outcome ETFs. Okay, I'm not a huge fan because they are very costly. Now, the question is, do the costs, are they justified by the benefits? And my answer would be probably not. Because most of the time, yes, the stock market is going up. And even if you hit a crash, we have some big bounces out of crashes. Okay, I'm not saying that they can't be beneficial over some period of time, but my internal thought here would be that if you just stacked them up over a long period of time, yes, you may decrease the volatility in your portfolio, but you may give up far more in the way of net returns than you ever hoped to. Okay, I don't think the idea is bad. I just think maybe the structure is bad. And it's funny that we're talking about structured products, and I think that the structure is bad, right? But nonetheless, let's think about some alternatives to defined outcome ETFs, okay? Investors' interest in products that focus on capital protection is comprehensible. Given that the global pandemic has occurred, we've had some big run-ups in the stock market and prices, right? While institutional investors had traditionally allocated to hedge funds, the realization has set in that high fees, lack of transparency, and little to no alpha generation, alpha meaning making greater returns than the market itself, make these funds largely unattractive. However, investors can also consider low volatility or other option-based products like put-right strategies as an alternative to the defined outcome ETFs. Both of these are available as ETFs, but are 50% cheaper in terms of management fees and less complex. Given that most of the defined outcome ETFs in the U.S. have only been launched recently, there are no long-term track records of realized returns available for analysis. However, the CBOE calculates that the S&P 500 Buffer Protect Index, the SPRO, which is the index used in some of the products and offers back-tested data since 2005. The index allocates equally to 12 sub-indices, one for each month, that have a buffer of 10% and a cap. We observed that since 2005, the S&P 500 has generated significantly higher returns than this index, which highlights the long-term impact of a capped upside in a strong bull market, right? That's a big key. If you are in a bull market and you have a capped upside, that can be a problem. The low volatility index, by contrast, generated similar returns to the market, while the put-right index had returns more comparable to the SPRO. However, and more importantly, both the low volatility and put-right indices offered similar reductions in maximum drawdowns historically relative to the SPRO index, and therefore could be considered as similarly effective but simpler alternatives to defined outcome ETFs. Okay, so what are my thoughts? I just said, a moment ago, I'm not a huge fan because of the costs. I think the costs really put a damper on these particular types of products, right? I think we always have to be wary of the fact that financial institutions are constantly trying to make money, and they are constantly trying to make things more complex, but market them as things that are, best for the investor, best for the consumer, right? This is, just marketing 101, right? You call these defined outcome. What does defined outcome sound like to the novice investor, to the individual who's just scared to put their money to work? But here's defined outcome. Oh, defined outcome. That means I'm going to make something predictable. It's going to be predictable what I make over time. It's going to be a predictable return, and everything's going to be good. And it tracks the S&P 500. Great. But it's a predictable return, right? That's not true, because you can still have drawdowns. The drawdowns are just limited. And then when bull markets are occurring, I've seen this before. As an investment advisor representative, I saw this before, right? You see individuals in things like indexed annuities, right? Which indexed annuities in form aren't way different from these products, but that's for another day and another time, okay? But you see individuals who have capped upsides, right? You see individuals who don't get the full return of the S&P 500 or of some index, right? And the bull market is absolutely roaring. And they're kicking themselves for the fact that they're not getting those returns. But these individuals haven't taken into account that they actually have a risk profile, that they actually have, this idea of risk and return, right? You take risk, you make some return for that risk, right? If you take more risk, then there is also going to be the likelihood that you could lose some in the short term, right? Which those individuals were never ready to do. But they sometimes wanted to put more money to work just in the S&P 500 or the market as a whole because they were afraid. They were fearing to miss out, right? The fear of missing out, FOMO, is huge in investing, and it plays a part here as well. Now, what I foresee, right, is a lot of the individuals who jump into these types of products, especially as the market gets bubbly and frothy or whatever you want to call it, right, as it's very highly valued for a long period of time, right? What I expect is that you'll have people that jump into these types of ETFs and say, this is going to be the time that this is all going to pay off. And they might not be wrong in the short term, right? There might be some huge drawdowns where they actually make some money, and good for them, right? But then the question becomes this. If you're using this type of product, the question becomes this. When do you divest? When do you take money out of it? When do you go back into the market? When do you go back to traditional styles of investing, right? If the answer is, I don't know, then we have a problem, because what's likely to happen is you're likely to, miss out on some of the drawdown, right? Which is great, but then you're likely to miss out on a lot of the upside, right? And if we get a roaring bull market on the other side of the next crash, which every single crash that we've had a roaring bull market on the other side of it, right? And you're missing out on returns because you can only make 8.5% every year. I mean, that's a problem, right? That's a big deal. And we don't want to be giving up returns in that way. Not only can you only make 8.5% every year, right? You have these fees that are huge. You're missing out on dividend reinvestment, which is huge, right? My suggestion, or not even a suggestion, but these are my thoughts, right? My thoughts are there have to be better ways to decrease volatility, right? There have to be better ways that we can go about de-risking our portfolios in a way that will, decrease correlation of our assets, provide more stability, and do it in a more sustainable long-term way. Because what it seems like is that these types of products are trying to, play the market in a shorter-term basis, and we are not short-term speculators in what the market's going to do tomorrow or next week or next month or whatever. We are long-term investors, meaning we are looking years ahead. We're looking years ahead and saying, hey, I believe the market will go up over a certain period of time. I want to be invested in a way that I can benefit from that. And I need to be invested in a way that's commensurate with my risk profile over a long period of time. Not saying I'll take a lot of risk here and I'll take less risk here and a lot of risk here and less risk here. That's just not the way to play the market. We are not playing. We are not trying to time the stock market, because that is consistently a loser's game, right? And the people who made ETFs, they just thought of them as an easier way to invest in the same things that you could get with mutual funds, right? It was lower cost than many mutual funds. It's more tax efficient, right? They think it's just a better product. And by all intents and purposes, they have been, right? But then you look at the distortion of ETFs. You look at leveraged ETFs, like multiple times leveraged ETFs. You look at inverse ETFs. You look at these defined outcome ETFs, and you can see a lot of problems that occur. And these ETFs aren't so low cost anymore, right? You get these types of strategies, and it is costly to get these types of strategies, right? And I don't think that a lot of individuals who get into them probably understand them, which is unfortunate, right? Yes, they help you, limit your downside. But so does, having some stability in your portfolio from cash or from, some bond allocation or, lower volatility stocks, right? Some, blue chip dividend paying stocks or something, right? You can provide stability to your portfolio in different ways, right? It's not the idea of I'm either all in the S&P 500 or I am all in cash, right? There are many different ways that we can structure our asset allocation in a way that can decrease volatility. Now, bear markets are inevitable. They're going to happen, right? And if you're going to invest, you need to learn to deal with bear markets and not try to time the downside, because there's the old saying, and I'm probably going to butcher it here, but it goes along the lines, markets can stay up, right? Things can stay overvalued longer than you can stay solvent, right? Basically meaning that assets can keep going up and up and up longer than you would ever dare to bet against it going up and up and up and up, right? So eventually what ends up happening to a lot of people as markets continue going up and they've bet on it going down, what happens is they'll end up trying to take the long position and getting pieces of the market going up. And then guess what? They'll take the crash anyway, right? They'll be a part of the crash anyway and then be sad that they got no upside and they got all the downside, right? And that's not what we want. We want to be long-term investors. We want to have an investing process. We want to be simple in the way that we invest. The more complex we try to get, the more crazy we try to get with the way that we invest, the more that we're going to pay in fees, right? The more we're going to miss out on in the way of returns, and the more short-term oriented we're going to become. I don't want you to become short-term oriented. I want you to look into the long-term, look into 20, 30, 40 years from now, because most of you have it. Most of you have that much time in order to invest your money. So don't look at the short-term fluctuations in the market and think, I need something like this, right? Leave this to, institutions, leave this to individuals who don't know what they're doing with their money, right? But you should be staying away from high costs You should be staying away from things that have caps on your gains, right? You should be staying away from things that are strategies that you don't know how they're setting that cap. You don't know how they're limiting the downside, right? Because they must be doing it somehow. And if you don't understand how, don't invest in it. Know what you own, know what you're invested in. You'll be better off for it. And I don't think these defined outcome ETFs are a way that we can actually build wealth in a reliable way over a long period of time. But it's a fun conversation, and it's interesting to learn about a new investing product and be aware of these if they're ever marketed to us in the future. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.